Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. The key event for markets in the week ahead will be the earnings from Nvidia. They are due on Wednesday, and at the risk of stating the obvious, there has been tremendous scrutiny over the AI trade lately, and Nvidia's results could trigger further rotation out of the AI theme, even if the company does beat. I think the critical question here is around sustainability of demand. And if guidance fails to meet expectations, you can expect this stock to fall not just in the U.S., but in Asia as well. Nvidia is almost as closely correlated with Taiwan's TAIEX as it is to the S&P 500. Remember, TSMC's weighting in the TAIEX is more than 40%. And of course, TSMC is the foundry for the production of those NVIDIA chips. Now, at the same time, here in the States, the government is working to reschedule economic data. Markets have been forced to rely on a lot of private surveys. For a closer look now, I'm joined by Chris Maxey. He is managing director, also the chief market strategist at Wealthspire Advisors. Chris is on the line from just outside Washington, D.C. Thank you, sir, for making time to chat. It seems like the two readings on the labor market that we will get on Thursday are the most critical, that being the weekly jobless claims data and the numbers on September payrolls. Wouldn't you agree with that?
You know, Doug, I think the jobs data is going to be a very key focus for participants. What we've seen in just the last couple of weeks is a lot of irregularities, if you will, on the labor market, whether it was the ADP report or the Challenger layoffs. And for a lot of folks right now, they're saying, okay, where is the job market? If the hiring's not there, but we're beginning to see a pickup in layoffs, is that an indication that perhaps the Federal Reserve is falling a step or two behind what they need to be doing? It doesn't necessarily look like that's the case just yet. I would imagine that we'll find out. The labor report is going to suggest some positive growth. We're not to the point where layoffs are really accelerating to the state that would cause any kind of consternation. But I do suspect there is going to be a tremendous amount of focus on that report, because of what it leads to in potentially December. Are we going to get the other rate cut or are we not?
So a lot of the Fed speak that we've been hearing recently has focused more on the inflation side of the mandate than on the labor market side of the mandate. Is the Fed wrong to be a little concerned about inflation in the way that we have heard it discussed?
I don't necessarily know that wrong is how I would characterize, but I do think that what we're going to find out is the labor market potentially weakens before we see inflation roll over and come back down. It has been quite a while since we've had inflation anywhere near that quote unquote 2% target. And I can't imagine we're going to be getting there in the near term. You know, just as we look at the elections that happened in America a couple of weeks ago, there was a ton of focus on cost of living, on prices being too high, on the voter base being unhappy with that. And I think that's a big part of why we saw tariff rollbacks that happened on Thursday and Friday of last week with a lot of food products in particular. So what I would imagine is that the government is going to work pretty aggressively to try and get cost of living under control. We have midterm elections next year. They don't want that to remain a focal point of the election cycle. And so the Fed focus on inflation. I get it. I understand that. But more importantly, we have weakening in the labor market that's showing up very presently right in front of us.
So when you look at the kind of the weakness in consumer sentiment, do you see that more as a reflection of the choppiness of the jobs market, or is it an inflation story?
I think it's a bit of a mixed picture there. The issue we have is that prices have gone up and they have not come back down. We see certain pockets, whether it's auto sales, for instance, where the price of a used auto has come down. But for the most part, everything else has gone up after 2022 and just simply never went back down. And that's the part that people are really wrestling with right now. Are they feeling that their wages are growing quickly enough to offset that cost of living that's going up? And I think the answer that we're seeing from those consumer sentiment reports is simply no. For the vast majority of people, they're not feeling like their bank accounts are filling back up. They're not feeling as though they have the opportunity to succeed right now. But there is a bit of a disconnect here, I think, as we all know, and a lot of people have been talking about. There's the disconnect of the top income households and those at the bottom. 2022 was a story about wages rising for lower income households. We haven't seen that be the case over the past 2 years. And as you think about consumer sentiment reports, I think it's reflecting that dichotomy beginning to grow further and further apart. As asset values have gone up, home prices have gone up. We see the stock market having been up quite a bit again this year. And so that gap continues to widen from the top and the bottom.
I understand that. But when you look at the problems that we have been facing in the labor market, I'm wondering whether you think there's a bit of structural kind of redesign that's happened, and maybe immigration is a part of that story. And the reason that I bring this up is that is there not a debate over whether or not lower interest rates is the right prescription to address labor market weakness? Maybe we've entered an area where lower rates really won't provide the juice that they have in the past.
Yeah, I think you're right on point there. Immigration is something that hasn't gotten as much conversation here recently, but it's definitely impacting labor markets. And, when we look at something like the wages of a native-born versus a foreign-born employee, there's a pretty big discrepancy where the average non-native employee makes about 87 cents on the dollar relative to somebody that was born here. As you think about the rotation and the cycle that might be happening underneath the hood of the labor market, that does place a bit of pressure on the inflation side. And that could be why the Federal Reserve is saying, no, we still need to focus on inflation, despite the fact that maybe tariffs are getting rolled back and that will start to roll over. But you do have to wonder if the labor market starts to shrink or get smaller because of things like immigration, what does that do to economic growth? Thus far in the year, I think we've all seen that it's been okay, largely because of the AI trade and the AI story and that boom in CapEx. But one has to wonder, how long can that persist and go on for?
Well, that's a great point. And it kind of goes back to the point that you were talking about earlier about the wealth effect in the equity market and how that has helped to empower consumers, particularly at the upper end of the income strata, those that have exposure to the equity trade. So if there is some type of faltering in the stock market that would maybe cause people to spend less, is there the risk of a recession in that scenario in your mind?
I don't know that we're there quite yet. Even as much as we say perhaps the AI trade could roll over, even what we're seeing in these last couple of weeks is simply a reset of what was a pretty concentrated set of positioning in the markets. And, it would be hard to argue that that wasn't the case. So I think what we're seeing these last couple of weeks is simply a reset in positioning before people get ready for this ramp up into the end of the year. And at that point, you can start to look into 2026 and say, okay, what's on the docket? What's on the horizon? When you start to look at 2026, there are still a number of positive tailwinds that are in place, whether we're talking about the One Big Beautiful Bill Act and the potential for that to really accelerate corporate spending, whether we're talking about the asset values for top earning households being high enough such that they're going to want to continue spending. So you look at the real estate market as a great example. The real estate market is still very tight. And as much as people are talking about, there's not been a lot of activity in the real estate in terms of transactions. The reality is that most people own their house free and clear right now. The average carrying cost of mortgage that does exist for those houses where there's borrowing is still quite low. And so you've got a different situation going in the housing market where it's hard to imagine prices resetting all that much lower. And so I still think as you look into next year, you've got these tailwinds that are in place that are going to be supportive of the overall economy. It's just a question of when we need to start rethinking the AI trade and if that's going to begin to push down economic growth. I think that's a ways off.
So as long as we're talking about the tolerance for risk, maybe we can address what's going on in Bitcoin. In Sunday trading in New York, the price dropped below the closing level of 2024 in early trading. And with that decline, the year-to-date gain for Bitcoin up 30% from the beginning of 2025, that has evaporated. And I'm wondering whether you think that it's any type of reliable indicator when it comes to the tolerance for risk.
I don't know that it says anything about the broader economy, but I think specifically to Bitcoin itself, you have levered players, and levered players come and go. There's a lot of psychology and behavior that's involved there. Those behaviors can also ebb and flow. And I think what we're seeing right now is just one of those moments where the psychology is stepping into reverse. So much of the conversation was SEC approving Bitcoin ETFs, and that's going to lead to this massive adoption and growth in assets. And it has done that to a certain degree. But when you have levered players that are involved in a market like that, particularly when there's only a single asset class, if you will, they can flee very rapidly. And when you see drawdowns that we had in the middle of October, where Bitcoin was down 10% in the course of 5 or 6 hours, it gives you an indication that this event was likely coming, and you're going to have a reset in positioning before it reaccelerates, right? That this is just the continuous cycle of cryptocurrencies and Bitcoin. We see this in speculative parts of the stock market too. It's just human psychology at the end of the day. I don't know that I would ascribe a whole lot more to it than that.
Chris, we'll leave it there. Thank you so very much. Chris Maxey is managing director. He's also the chief market strategist at Wealthspire Advisors, joining from just outside Washington, D.C., here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Japan's economy contracted in Q3 for the first time in 6 quarters. On an annualized basis, negative 1.8%. Now, contraction was not going to be a surprise at all. In fact, this is better than what economists had forecast. They were looking for negative 2.4%. And all of it comes as Japan's new Prime Minister Takaichi is preparing some major stimulus. Bloomberg's Paul Jackson covers the economies of Japan and South Korea.
The fall was expected. We knew there was going to be a pullback from exports over the summer because we had the bringing forward of exports in the previous quarters. Companies tried to beat the tariffs of Donald Trump. So that part was expected. We also knew there was going to be a sharp drop-off in spending on housing. It's actually a third fall in the amount spent on the property market, reflecting environmental changes, regulations that came in. So there was, again, a flood of spending before the spring, and then that's tailed off.
That is Bloomberg's Paul Jackson. So let's take a look ahead now to the outlook for emerging markets in the new year. That would include China. Trinh Nguyen is the emerging markets Asia economist at Natixis. She spoke earlier with Bloomberg TV host Paul Allen and Avril Hong. Now, Trinh has a cautious outlook for the new year, and the conversation began with a question about her trepidation.
We are starting this year with much more caution just because 2025, despite the bark of tariffs, has been quite great for EM Asia. Exports were pretty strong thanks to front loading, thanks to the ICT cycle upturn, and of course the big deployment of AI that helped the big chippers. And that has helped mitigated a lot of the drag. And more importantly, Asia central banks had plenty of room, given the soft dollar, to cut rates. So we're looking into 2026 with much more trepidation because a lot of this is running out of steam. We're looking at almost the end of the cutting cycle for a lot of emerging Asian economies in rate cut. There's very limited room for that. But at the same time, exports are slowing, right? Demand is decelerating in China very rapidly. In the U.S., demand is likely decelerating also very rapidly. So as a result, we're very cautious on the exports for the next year, exports outlook for the next year, especially for Asian big traders and those more exposed to the chip cycle that have performed extremely well this year.
Trinh, we've been seeing in the past 2 months or so lots of central bank surprises, increasingly hard to predict what policymakers are going to do. I wonder, though, going into next year, the risk, should we be talking not just about rate cuts or holes, but about rate hikes, given the inflation trajectory?
Absolutely. So one of the big concerns when the China data came out in October really is what is the policy reaction function, given the fact that data has been very underwhelming. And despite the fact that China has really high real GDP growth, nominal GDP has been very underwhelming, meaning real debt has risen for households, for corporates, so they find it easier to pay down debt. So the move forward obviously is cutting rates, but it's not so obvious as the dollar is quite uncertain what direction that will lead. So for Asian central banks, we're reaching at the end of the traditional monetary support. So we have to look into fiscal support. So when we are looking at into 2026, where a monetary tap is running dry and fiscal policy is getting much more loose, there's a big question that who is going to absorb a lot of this debt. Obviously, fiscal policy is supportive for growth, especially for the pro-growth agenda. And we're looking at South Korea, China, Japan, Indonesia, many countries easing fiscal policy. So that's a big concern. But fundamentally, we're not as concerned about inflation just yet, given the fact that we fundamentally think the output gap is quite a negative in Asia across the board still. So domestic demand is the weak link of the equation for Asian growth. Exports have been strong, so turning to next year, fiscal policy we need to support. And oil is an important equation, and food prices as well, because oil we expect to be quite subdued, and food has been favorable. So the risk factor is that those factors will rise. We don't think that is the case. So meaning inflation will remain manageable, but we don't have a lot of space as we've already front-loaded a lot of these policy supports.
Yeah, Trinh, we've got a case study today. In fact, you mentioned Indonesia there. I mean, there is a case in Indonesia for a cut, but to what degree, to your point, is inflation standing in the way here? And if you do see fiscal stimulus in Indonesia, that sounds like it's hardly going to help the problem.
Absolutely. They've cut the most in Asia, 150 basis points of cut. Really surprised markets when they've been very dovish in front-loading that cut to pause. But the reason for the pause is very clear, is that the gap between the Fed and Indonesia is really very, very narrow. If they were to cut this week, that gap would narrow from 75 basis points to 50. And the market is uncertain where December is going to be for the Fed, right? Will it cut the upper bound from 4% to 3.75 in December? Given that is so uncertain, a lot of central banks are not going to take that risk, particularly when their nominal policy rates are so low. And inflationary pressures are actually rising marginally for Indonesia. So real rates are actually getting worse. Some other central banks have much more space, like India, for example. Inflation has been very, very low. They have a lot of space. But given uncertainty, again, this elusive India trade deal putting a lot of pressure on the rupee, the central bank also is not really the one that with a lot of space to cut are not really cutting. So therefore, this caution is going to continue until we get clarity on where the growth outlook for the U.S. is. If the growth outlook is very, very decent, and at the same time we have a soft enough for the central bank to cut and inflation is benign, then maybe we can have a much more optimistic outlook for 2026. For now, given the fact that we have the export cycle turning down and growth picture very weak, and big question, of course, is China reflation trade, right? Will China do enough fiscal to really reflate its economy, import more from the rest of Asia versus this year where imports have been quite weak?
Trinh, we've only got about 30 seconds remaining, but I do just want to quickly get your views on the risk posed to some Asian economies from potential correction in AI stocks. Just very quickly.
So if you look at Korea, what the best stock market in Asia, not talked about much, is really chips. Chips have done really well. Autos have been very much down. With the trade deal, with the lower of tariffs, I think autos would do next year much better. But the question is, will chips continue? And the cyclical factor is fading, given the cycle turning into year. So we may still have very strong first quarter, but I think the risks are really there that chips that have driven a lot of this exceptional growth in Asia, it's going to decelerate. So we looking at 2026 with cyclical factors, risk rising, and at the same time, fundamental growth is looking very saggy globally. So the big question is, how big are we going to get regarding the fiscal bazooka into 2026 to offset the external stress that we're going to face?
That was Trinh Nguyen, Emerging Markets Asia economist at Natixis, speaking earlier with Bloomberg TV host Paul Allen and Avril Hahn, bringing it to you here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.